Hey guys, today I'm thrilled to welcome Chad Johnson from NFM Lending to the show. Now, whether you're a first-time home buyer or looking to refinance your current mortgage, Chad's here to share some invaluable insights and tips about the home mortgage process. So get ready to demystify the mortgage process and learn how to navigate it like a pro. You're not going to want to miss it. Stay tuned. Hey guys, welcome to today's show. I am Brad Nelson, founder of The Debt-Free Dad. I paid off about $45,000 in debt, have been debt-free now for more than 11 years outside of my mortgage. I've also been fortunate enough to help thousands of other people save and pay off tens of millions of dollars with the work that we do here at Debt-Free Dad. Now, after listening to this episode, if you want to take your finances to the next level, if you want to make better progress in as little as 30 to 60 days, I'm going to be sharing some details about how you can get started with that later on in today's show. So, hey, Chad, welcome to the Debt-Free Dad podcast. So glad that you are taking some time to hang out with us today.
Yeah, glad to be here. Thanks for having me on.
Yeah, absolutely. So if you could you just briefly just introduce yourself and what makes you maybe the subject matter expert? Now, I know a little bit about you because I found you on TikTok, and I've been wanting to get you on our show for quite a while. And I love what you're doing on TikTok, and I hope you could share a little bit about that, where some of our listeners can find more information about you. And because I think you're doing a really great job about educating people about the mortgage process and what's all involved through TikTok. It's pretty cool.
Yeah, I'm definitely on TikTok. It's Chad Johnson KC, Chad with 2 Ds. My mom went ahead and screwed that up for me forever. I started on TikTok 3 years ago doing this. Man, I was just like, I don't know if this is how I should be reaching out to people, but I was like, let's try it. Kind of start off being fun, making videos, kind of touching on mortgages or housing market, but mostly just somewhat entertaining. And then I realized that, man, I can really reach a large audience, and what I'm saying better be accurate and impactful. And so I started taking it a lot more serious, and I saw it as a medium to, I don't know, maybe cut through the gatekeeping in my industry, and at the same time try to break things down simply and fun for individuals, just for the mortgage process, the home buying process in general. I've been doing loans for about 9 years now, and the first 6 years was just pounding the phones, going to realtors' offices, whatever, and doing all that. But I've just really loved being able to reach the people that kind of TikTok and the algorithm says I need to reach, and being able to deliver my message in a really efficient way. But my main focus is first-time home buyers. It's on trying to, I guess, inspire those that can afford to buy a house, but are kind of maybe scared or nervous or frozen. And especially in this market, which it's understandable to be confused because things have changed so fast, in such a short amount of time. That's really my passion, is to just inspire those that, hey, you can buy a house if you have these credentials. It's not always easy, but give it a try. Don't be scared, or don't be nervous, because whatever the misconceptions are. So that's really my aim in general.
That's what I like about your TikTok, though, because I think I don't think I've ever shared this on my podcast. We've been doing this now for over 4 years now. We got 250 plus episodes here. I don't think I've ever shared, but I had a real quick stint in real estate. I was a real estate agent for less than a year, and I remember back then there was a statistic, and I don't know if this is still accurate, but I remember them saying that buying a home and going through this process is one step lower as stressful as finding out you have cancer. That's what they had said. There's a lot of stress to it. And I think that's what's great about your TikTok channel, is that, you are taking that stress out of it, and you're breaking it down into easy concepts and ideas for people who are a little bit hesitant, especially in today's market right now. So that's what I love about it.
Yeah, I appreciate that.
Yeah. So if I'm in the market to buy a house and I'm a first-time home buyer, what are some things that I should be considering as I get started? Can you share, if I'm a first-time home buyer, you should do this and get these ducks all in a row? What would that look like?
My first phone calls with clients, it really is this simple. it obviously expands off of these questions, but it's income, it's assets, and it's credit. Whatever order, it doesn't matter. It's not like a priority. But first, we got to figure out what your income is based on guidelines. Just because you make a certain amount, you get paid a certain amount, doesn't mean we can always use that income. So that's a conversation all in itself. I'm actually going to make a video today about, can I use income right away if I just started a job, or what are some, because a lot of people, it is confusing that we can and can't use commission. Sometimes we can and can't use tips or bonus, or we need 24 months with certain loan programs, all that stuff. So I first had that first conversation with, hey, what's your income? In general, try to be at your job about 6 months. 6 months to a year is ideal, obviously. Then the second thing is, it's called assets. That's just how much money you have for down payment, closing costs, potentially reserves. Don't always need all that, but just kind of gives us an idea of what we're working with. Most loan programs that I do, first-time home buyers, are 3 to 5% down.
Okay.
You obviously don't have to have that. It can be a gift. It can be 401k, whatever. But really, 3 to 5% down can dang near all loan programs. Then the third thing is credit. Credit, I make videos I'm sure you've seen about. We can go down to 580. That gets people all excited, which understandably so. But it's not just, 580 and you're good. We might need more assets and reserves, or we might need a lower debt to income ratio. So really, in general, to answer your question, for credit score, I would try to shoot for like the 640 mark.
Okay.
640 mark really opens up a lot of loans, especially in the government area, USDA, VA, and FHA.
Sure.
And then if you're wanting conventional, probably shoot for like 700. So those are kind of the two tiers I would look at. First, try to really get to 620, 640. Then conventional, be shooting for 700 plus, the better, or the higher the better.
Yeah. So when you're talking about this whole process of buying a home, in your professional opinion, when should someone start talking to a mortgage lender? Like where does that fit in this process in your opinion? Should they do that first before finding a house, or what does that look like, you think?
Yeah, definitely. It's really the actually first thing to do. I mean, I know people are going to just hop on their phones and look around at Zillow if they're interested in buying a house. Right. I'm not going to say stop doing that. But, the whole point I say talk to a loan officer is because it really establishes, hey, realistically, this is what you can qualify for, not afford. This is what you can qualify for.
Yeah.
And then you go from there, whether you like or don't like the answer, at least it sets you up for correct expectations. Because if you're looking at a $350,000 house, but you can only get 300 or 275, it can kind of, if you never looked at the 350, it might, be better if you knew 300 was your max and you only looked at 300. So
yeah,
I would say always do that. And then as far as timing, there really isn't too much. You really can't be too early. The only time you could be too early to talk to a loan officer would be as if, let's say you talk to me and you're saying, hey, thinking about buying in a year and a half, even 2 years. Well, if you get a new job in between them, or if you move or something, like we'll have to talk again anyways. Not saying we still can't talk, but probably a year out is what I would say the most.
Yeah.
I mean, a lot of things can get fixed within that time frame. I say a year because sometimes income, we need you to be on the job for a little bit longer. If it's variable income like tips, bonus, commission, overtime, whatever. And then also credit. Sometimes people don't know the problems on their credit because they haven't even looked at it. There might be errors that need to get fixed. Well, those take a little bit longer or whatever. So a full 12 months can give us plenty of comfortable time to where if we did this 3 months before you're wanting to buy, it's like, crap, I missed out on that house because my credit didn't get it repaired, or I didn't know I needed to stay at my job. If I changed jobs, it was going to be a problem. So yeah, I'd probably say about 12 months.
12 months is a good rule of thumb. Yeah. And I love that you brought up that, what you can qualify versus what you can afford. Can you explain what you mean by those two things?
Yeah. Um, Qualifying is simply based on mortgage guidelines. Sometimes you can qualify for more than what you can afford or what you want to budget for that. Sometimes you can qualify for less than what you can actually afford because of guidelines. Like, let's say you make a bunch of commissions, but you haven't been in that job long enough. So you're bringing in plenty of money, but we can't count it yet or whatever.
Right.
So qualifying is strictly a mortgage term in terms of like, this is what we approve you or pre-approve you for. And then what you can afford is simply it's very personal. You hear all these gurus, they might have rules of thumb on 35% of your income, your net income, gross, whatever. It doesn't really matter. What matters is you sitting down, doing the boring stuff, doing your budget, breaking it down and saying, hey, this is what I'm comfortable with. And after I talk to Chad or another loan officer, I'm not going to change that.
Right.
Because we are buying something and it gets exciting going out and it's like, oh, I want a $250,000 house, but this $280,000 house actually has the fence I want and it's got the corner lot or whatever. That's where you need to stay disciplined with your budget. My qualifying side doesn't mess with that. I say, hey, you can buy 350, but
right. I love you. Yeah, and I love that you bring it up, and I love that you talk to your clients about that, because I think I've worked with people as a financial coach who say, I'm looking to buy a house, I'm qualified for this much, and this is the house I'm looking to buy, and I will have that same conversation. Well, I understand that that's what you're qualified for, but does that actually fit within your household budget? Because you also have to consider things like repairs and maintenance and upkeep of that property as well. And if you're eating up the entire income that you bring in to now buy this home, you're going to be putting yourself further into debt to maintain that home. And they say what do they say is 1% to 3% of the total cost of the house is typically what you can expect in repairs every year, roughly.
Yeah. I mean, you're in Wisconsin. I'm in Missouri. Our weather's pretty harsh here. So,
right.
I've had to I just replaced my sump pump. I replaced my fence a year ago, HVAC, fridge, hot water heater. So not saying you're going to replace all this stuff as much as we are, but it matters the climate, it matters the age of your house, it matters the condition when you bought it. You might get a 1-year warranty, but you can't just rest on that forever. Right?
Yeah, right.
So it just kind of, which goes into the second part of affording a home. It's, can you handle if something happens in the first 2 years? Having somewhat of a sufficient savings, I've got some rules of thumb on that. But again, it's your comfort and it's your situation. But really need to be able to handle. Like I said, my sump pump went out and we had to pull up the carpet and just replaced a garbage disposal. Stuff's going to happen. These are, I was thinking about this the other day. When you own a home, think of it as you are a property manager.
Yeah.
Because really these homes these days are big, a lot bigger than they used to be. And so you're a property manager.
Yeah.
So there's just going to be normal expenses that you need to be able to handle, and then definitely maybe some big repairs. So
yeah, for sure. I read a statistic. Actually, I think I shared this in our membership, but the average home size has nearly tripled since the 1960s. So it's pretty crazy.
Yeah, if you really think about it, I mean, these are big homes.
Yeah,
just that's what we all want, and that's a lot of area to cover with electrical, plumbing, all of that.
So can you share a little bit briefly, and I know, we may not have time on this show to go through every single type of loan, but can you briefly just kind of cover the different types of loans like a first-time homeowner would be looking at? I know you said credit scores can kind of determine what you would qualify for, but what are you seeing as the most common loan programs people are getting into as first-time homebuyers right now?
So this is another important thing to understand. Really, there's 4 loan programs, period. So there's conventional. That's the agencies are Fannie Mae and Freddie Mac.
Yep.
Then there's the 3 government loans, which is FHA, VA, and USDA. So those 4 loans are pretty much all loans. Any other loan you hear about is either like an add-on to one of those loans or an addition or an additional feature to one of those loans. So just first and foremost, I like to bring that up because it can get overwhelming when you see like, here's a list of our loans. Well, it's really those 4 loans in a somewhat of a mix and match with different features, whether it's income, whether it's, you're a doctor, a firefighter, different county, certain census tracts based on trying to get minorities in homes, whatever it is. There's all kinds of programs, but they all kind of fit in those 4.
Yeah.
But were you asking what are most first time home buyers fitting into right now? Is that what you
Yeah,
said?
I would say, yeah. And is there any like major differences between all of them, or is it literally just kind of come down to more credit score and what you kind of fall into based on that?
The main thing, really, FHA, which is a government loan, that applies to everybody. You don't have to be a first time home buyer. And a lot of people are using that loan, first time home buyers, and you don't even have to be a first time home buyer because affordability is such an issue. FHA has the most leniency on the debt to income ratio. It goes up to 56.9,
Wow.
meaning your total monthly debts on credit,
Yeah.
including the mortgage payment we're trying to qualify for, can potentially be up to 56.9% of your gross income.
Yeah.
You know, conventional, it's only 50. USDA, it's like 43, 41. VA might actually be the most lenient, but it's pretty select group. You got to be a veteran or an active duty military,
Right.
and then you have to have served long enough. So really, a lot of people, again, not only just first time home buyers, are really fitting into FHA just because of that affordability issue. And on top of it, once you have 640 credit on FHA, you have the best terms on FHA. You could have 800 credit. You're going to have the same terms as some with 640.
Gotcha. Okay.
So it really, really a great loan program right now, especially in this affordability issue.
Yeah.
If you've got bigger down payments outside of 3.5% for FHA, like 10, 15, 20 on, you probably want to start looking at conventional, if you've got 680, 700. There is a really good conventional program if you do have higher credit, which is Home Ready, Home Possible. You can do a 3% down, as a first-time home buyer. You do have to be under the area median income.
Okay.
Which you can just look that up online. But basically, those 2 loan programs, FHA and the 3% down conventional, if you have really high credit and your income's under the area median income, most of my clients are fitting in that box.
Okay.
Obviously, if you're a veteran,
Right.
you're buying out in a rural area, you might want to look at USDA.
Okay.
So that's what most people are looking at.
And what would you say when people are applying for a mortgage? What are some of the main reasons maybe why they're getting denied? Is there particular things? Now, I don't want to say it, but I hear from a lot of mortgage lenders on my TikTok on why people are getting denied. But I'm interested to see what you kind of see on a regular basis in your line of work and working with people.
Yeah, it's debt to income ratio. It's very much that. The affordability issue, even on FHA, we have issues with. Definitely, if we run into problems where they just switch jobs and they've got bonus from this new job or commissions or whatever, that's where it gets stressed. It's like, oh, they're bringing in this money, but I can't use it until I have 12 or 24 months. That's one issue, but it's really just, it's not student loans. It's car payments. It's mostly car payments and like maybe some other installment loans. Student loans, I mean, they can be a problem, obviously. Most people have payments established now as of February. If they're in forbearance or deferment, we only have to count 0.5% of the total balance. And a lot of people are doing income-based payments on their student loans. So you can contact your servicer, and those can be extremely small. So it's just, I've made videos about this. I think people are just not making the income that they should be, mixed with maybe just a little bit higher debt.
Yeah. Whether
it's car payment and other installment loans. Then obviously we tack on interest rates being mid 6s to mid 7s, depending on loan programs.
Right.
And property values have gone up a lot over the last 2 years. It's just a really stressed environment. And yeah, I wish I had the answer, but
Yeah, what
I guess in general, it's just I wish people made more money. Uh, you know,
I wish we all made more, right? Isn't that the thing? I wish we
yeah,
all did. Well, what I hear
yeah,
what I hear quite often is from mortgage lenders, at least on our TikToks, is a big one is car payments, and you mentioned it, and I think and I'm glad you brought it up because this is something as a listener to this show, if you're listening to this is one of the things I want you to think about. If you're in the market, you want to buy a home, but you're also in the market to buy a car, just understand that that car could be and that debt could be the thing that keeps you from buying that home, which honestly is more of an asset than the car is. You know,
yeah.
and
I've seen some of your videos. You're talking on maybe responding to somebody about like why is it bad to have a car payment or what you know, and to illustrate it a little better, let's say every $10,000 on a mortgage payment is about $70 a month, just as an example. So if you have a $700 car payment, that literally is affecting you $100,000
right.
as far as affordability on a mortgage. I see that all the time. It's not 700, but like even 500, 450, 600. I see some pretty big car payments, and I get it. Cars are expensive.
Right.
That coupled with incomes just haven't gone up like they should, and so
Right. Yeah.
something definitely to look at. And if you are thinking about buying, like, hey, maybe we should hold off, or let's really look at this thing because this will have a major impact.
Yeah, for sure. Yeah. And I love that you brought that up. So when people are going through the mortgage process, especially first time home buyers, are there any misconceptions where you work with people who are new and they're like, they think it works one way, but you're like, nah, it really doesn't work that way. Is there anything where there's just a common misconceptions that you're seeing?
Yeah, one of them, and I haven't made a video about this, but the idea of a first time home buyer, that is a thing, but it's not that big of a deal anymore. So it really used to be a marketing angle before '08, before my industry decided to freak out. They kind of, I think they are marketing products, first time home buyer, you can get in, and they were doing 80/20s and no income, they're doing all kinds of stuff. Now there still are perks of being a first time home buyer. I'm not saying that, but it's not like, oh, you're a first time home buyer, so let's roll out the red carpet.
Right.
It's like really most of these affordable loan programs, whether they're down payment assistance, whether they're specialty programs based on areas, counties, or certain census tracts trying to promote minority purchase or whatever, a lot of them are based on qualifying income or household income. So that's one thing that a lot of people don't understand is household income really, when you're talking specialty programs and stuff, really is one of the main drivers in our industry. That's one big misconception. Closing costs, maybe a lot of people are kind of thrown off by closing costs. What are closing costs? Aren't they just included in the loan?
Right.
And it's closing costs are simply third party, title company, home insurance, property taxes.
Yep.
All that stuff gets itemized, and it's an additional cost at closing that you can ask the sellers to pay some or all of it when you put in an offer, but it's definitely not just like lumped into the loan amount.
So can you talk a little bit about like some do's and don'ts when, you're getting ready to apply for a mortgage or even like you're in the middle of the mortgage process? Like you did a TikTok and this was interesting. I never really considered this and thought about this, but you mentioned a TikTok that you created about credit card balances. And you said, hey, if you have credit card balances and you pay them off every single month, but then you're in the middle of applying for a mortgage, there's potential that your credit score could come back lower because when they checked your credit, your balance was high, but then a few days later you paid it off and it was zero. And then you mentioned like sometimes some of my clients are a little confused as to, well, why my credit score would be lower when I pay my credit card off every month. So can you talk a little bit about that? And then also maybe some mistakes other people have made, like with applying maybe for more debt or anything like they shouldn't be doing when they're seriously considering buying a home.
One of the big mistakes I see people do it's really mostly with people who are trying to build their credit or trying to boost it up. If you've got great credit and you're paying off your card every month and you've been doing that for years, really doesn't affect things because you've got such a good track record. But it's for people who are like, oh, I'm like 600, 620, 640, but I'm trying to get to 680 or whatever. Well, if they're like, okay, I'm going to get a credit card and I'm going to run it up and then pay it off. Well, that will help. It'll just take far longer. And the confusing part is because we pull 3 bureaus and then there's all kinds of credit card companies and they all report to different times to different bureaus. So
Right.
do all that math.
Yeah.
It's usually towards the end of the month, maybe 22nd to the 30th, somewhere in there. So if you pay your card off after it reports, I pull your credit and you've got a higher balance. Credit might be a little higher than you want. I've got to use that monthly debt, all that stuff. So if you're trying to buy here within the next couple of months or really trying to build your credit, I would just keep your balance low the whole month.
Yeah.
I know it's kind of annoying, but just like use it like a debit card, or don't use it and then use like a debit card or something that just pulls from your bank.
Sure.
Again, we're just trying to we're trying to min-max, get the highest credit in the shortest period of time. And then the other thing is just like income and job stuff. It never hurts to contact your lender before you do any job changes. Sometimes it just doesn't make sense. It's not intuitive. Like, why would that be a problem? Well, we have to just go by the guidelines. Sometimes it doesn't make sense. It's like, you're right. I should be able to count that income. So I would say any type of income change, any type of job position change, even contact your lender, because that can really derail things almost more than anything. Because we might have to wait, like I said, 6 months, a year, even sometimes.
Yeah. The way the market is right now, is there anything that you would want your clients to know before even getting into the market? Things to expect, things to understand, just based on the way the market is right now?
Yeah, just really, things are probably higher than you think.
Yeah.
Yeah. And it's not me trying to like scare people. It's more like, don't even take my word for it. Run your own you can just Google a mortgage calculator, throw 7% in there, put the purchase price, put 3% down. That's your base principal and interest. Tack on, taxes, insurance. Just kind of wrap your head around like, whoa, this isn't even doable, or okay, that's reasonable. Because I'm starting to have that conversation initially, because I do this for a living. Some people just work at Ford or whatever. They don't, I don't blame them. They don't look at mortgage payments and interest rates and all that stuff. So I would say get familiar with the market, get familiar with the housing and the mortgage market. Obviously I can have that conversation with them, but even home insurance. I don't know if you've read articles or any stuff recently, but home insurance is almost worse than what's happened in mortgages and housing markets.
Right. It's crazy.
I just got my premium increase, which that happens just naturally with inflation, but I mean, it's big increases. You tack that in with, guess what? Property taxes got increased too, because all property values have gone up.
Right.
So it's just, like I said, everything's a lot higher than you probably think. And just knowing that, and again, going back to your budget, being disciplined about like, well, it is what it is. Go from there. Like, if you can't buy a house or it doesn't fit in your budget, it's not the end of the world. What is the end of the world is if you buy a house that's definitely not in your budget, something bad happens on top of losing jobs. That's where real problems happen. So just really be realistic about the market, your situation, your budget, and just come from that place.
Right. Now, Chad, do you work with people all over the United States or just in the Missouri area?
Yeah, I'm not personally licensed in 49 states. My company is, and that's the way we can help people all over the country.
Yeah.
So the only state we're not in is New York.
Okay.
It's kind of a litigation nightmare from what I've heard.
Yeah.
For outside states. So yeah, all states except for New York.
What would be What are maybe some red flags talking to other lenders? Have you seen, I'm sure you've heard some horror stories of people working with people. Is there anything that should be a red flag? Like, hey, I'm going to this mortgage lender and they do this. Like, it should be a sign that you need to leave.
Yeah, I would just really say trust your instincts. A lot of times, if you feel pressured or rushed, or you feel like you've got questions, but you're kind of being sped along, that's the first sign of you're not working with a mortgage advisor. You're working with a salesperson.
Right. Yeah.
A lot of mortgage loan officers and realtors are just salespeople. Unfortunately, the great ones aren't, because they understand they run a business,
right?
And this is a long-term play with a client. I say play. It's a long-term relationship.
Sure.
And so I tell people this. I could care less if you buy a house. Of course, I want you to buy a house if you want to buy one, but I care about providing you, the mortgage options that can potentially fit for you, and to also educate you to where you understand kind of what you're getting into. You're never going to understand mortgages like me, but
right.
I want to at least kind of empower you to be like, when you make a decision, you didn't feel like, I don't know what I'm signing, but whatever, we'll figure it all out.
Right.
That's what I did when I first bought my house.
Right.
I was like, what is all this? Whatever,
Yeah.
So I just want to give enough of education, and then allow them to kind of absorb things and not feel like, okay, here's a pre-approval letter, go buy a house. I get clients telling me all the time, like, yeah, sorry, we haven't found anything. I was like, never apologize to me that you haven't bought a house yet. I'm not calling you about that.
Right.
Like, we'll deal with it when you buy a house,
Yeah.
I always say, be aggressively patient. Like, once you get pre-approved, the pre-approval is good for about 60, 90 days. That's another discussion, but it's really good forever as long as nothing changes. We might need to update pay stubs and bank statements or whatever. But basically, if that expires or when that expires, you don't have to stop looking. You don't have to stop looking ever. A pre-approval is kind of ongoing.
Right.
I've worked with people for 2.5 years, and they're like, yeah, we're still kind of just looking around. Cool. Let me know if you need anything. Like, again, that's not my job to have you buy a house. My job is to give you guidance. So,
yeah.
I guess one big red flag is if you don't feel like you're getting guidance, but you're kind of being like a transaction, or if it's like if you feel sold or talked over, whatever, trust your instincts on that.
Yeah, it's really good advice. Yeah. And speaking of that education, Chad, where can our listeners find more information about you? And I know we talked a little bit about your TikTok channel. Is there any other place that you want to send people to if they're interested in learning more?
But I have a link tree through my TikTok.
Perfect.
All my social media is connected to my link tree, which pretty much allows them to apply or ask questions, or they can obviously DM me on any social media platforms at Chad Johnson KC, Chad with 2 Ds. But yeah, that's what I would say. Find me on the social media and connect with me however you want.
Awesome. Well, Chad, thanks so much for joining us here today. It's been great. For a lot of people, obviously, if you're new, or you're going to be a soon to be first time home buyer, this is some great information, at least to get you started. As Chad said, buying a house can be a little bit stressful. So it's good to have someone on your team that can kind of de-stress the situation and kind of walk you through it step by step. So thanks so much, Chad. Appreciate it.
Yeah, appreciate you.
All right, guys, if you want to pay off debt, save more money, and take control of your finances and start seeing some amazing results in just as little as 30 to 60 days, all you have to do is head over to debtfreedad.com, click on the green button at the top of the page, and we're going to show you how you can get started. As always, congratulations to all of you guys who are taking a stand for your financial life. Hey, we get that getting out of debt isn't easy, but hopefully with our help and with your consistency and discipline, we can promise you guys, this will be some of the best work that you guys do in your entire lives. Thanks for being on today's show, and we will see you guys on the next episode. Take care.